So start off with Soilbuild REIT now. We are still maintaining our neutral call on it. Target price of 66 cents, which is slightly lower than the previous target price of 68 cents. We are forecasting a DPU of 5.34 cents. That is an implied 7.9% yield based on last Friday's close at 68.5 cents. Let's go through the individual lines now. For the gross revenue, you see that there was a big jump, 9%. This was due to the inorganic growth from the acquisition of Bukit Batok Connection last year in 3Q16. However, this was offset by a lower rental at the other property, West Park East Central. Net property income higher by 11.7% year-on-year. Distributable income higher by 6.6% year-on-year. This was due to higher finance expenses and managers' fees. For DPU, DPU is down 4.4% year-on-year. This is there are two effects here. The first is the larger unit base from the preferential offering. This preferential offering was in conjunction with the acquisition of Bukit Batok Connection. And in this quarter, the manager has elected to take cash payment up to $500,000. In the past, all the fee was paid in units. So there's a difference between first quarter this year and first quarter last year. So if we adjust out the manager fees in units and assume that 500,000 was paid in units instead of cash, DPU would only be down by 1.2%. Okay, so we'll go through the bullet points now. The higher gross revenue was and lower DPU were in line with expectations. That was because Bukit Batok Connection, the acquisition was already known, and the dilution also was known because it's a 1-for-10 preferential offering. Lower gross revenue and DPU going forward as a Loyang Way security deposit is depleted. So if you remember, the Loyang Way property, which was formerly tenanted to Technics Offshore, the tenant has vacated the property already after they defaulted on their rent, and Soilbuild has been drawing down on the security deposit. There's a 1.3 million left in the security deposit, and this would last till mid-May 2017. So the next thing is that the manager has already found 2 tenants to take up some of the space, but this only comes up to 9% of the NLA, which is lower than our assumption of 60% occupancy going forward. So we have cut the gross revenue assumption and consequently cut the DPU as well. So our near-term DPU for FY17 and FY18 has been lowered by 2.4 and 2.3%. Next bullet point is manageable lease expiry of 12.6% by NLA for remainder of 2017. So of the whole portfolio, there's 12.6% expiring, and of this 12.6%, the bulk of them is occurring in the later part of this year, in the second half. In this quarter, the revisions were flat on a blended basis, so the renewals were at a positive reversion while the forward renewals were negative reversion. Some positive things to note in the quarter is that occupancy has improved to 91.8% from previous quarter 89.6%. quarter on quarter, the WALE has actually lowered. We believe this is because of more of the leases being signed on a short-term basis. So to conclude, our current target price represents an implied price to NAV multiple of 0.93 times, which we believe is fair when taken in context of Soilbuild being one of the smaller capitalized REITs. We'll now move on to the next portion of the webinar.
Morning everyone, this is Lindsay, your consumer analyst. So today we will be touching on Singapore consumer sector, which we actually have a contrarian view as opposed to the market's view following the results announcement or the news release last week, where retail sales actually dropped 2.5% year on year. In February. And having said that also, on Friday itself, Singapore Stats has actually released the results for the first quarter 2017's GDP growth, which are slightly below market's expectation of 2.6. It actually clocked 2.5% year-on-year growth. So with that, without further ado, let us look into what are the underlyings or the demand and supply dynamics that actually will move the Singapore retail landscape. So the title of our report for today is Loosening Purse String. To sum our presentation today, so we will be looking through that why we think that retail outlook brightens, and why we expect there will be a turnaround in near term. We actually think that there's a renewed optimism based on the better prospect of Singapore economy, which would lift consumer sentiment, and this is actually supported by a growing household net worth, which would push the wealth effect and hence spur consumer spendings. We'll be also looking into some of the indicators that show some positive signals on the retail landscape. The first will be on F&B spendings, and consumer behaviors that they are dining out more frequently as compared to last year. And we also look into the consumer preference, which is shifting back to revisit supermarkets as compared to mini-marts and convenience stores. And last but not least, we'll look into the cyclical expenditures, which we will be focusing on the indicator on luxury goods. Nonetheless, we are waiting for more evidence of economic growth trends and improved profits to catch up with the valuation. So we think that for this year, earnings is going to drive share price for consumer stocks, and hence we have a overweight rating on Singapore consumer sector. So let's move on to our first point, where we build our thesis around GDP growth as a leading indicator to retail sales. So how is that? So basically, how consumers' sentiments are being based on is actually on the economic growth of Singapore. And Singapore, being a small and open economy, is highly dependent on how the external global trade environment is doing. if we look back in the historical trade patterns, as you can see here, during the 2007 to 2008 period, where GDP economic growth peaked, and it hit when we got hit by global financial crisis, it actually started to decline. And you can see the similar pattern here in retail sales index. It peaked around 2007 to 2008, and we started to see a deteriorating retail landscape here. During this period, consumers tend to deleverage. Household borrow less to spend, and hence, when we see that US take on QE, Singapore follow the same footstep as well. So at a near zero interest rate, we see that consumers starting to borrow more, starting to spend more. You can see that there's a spending spree here, and this is actually backed by more evidence or more clarity on a sign of economy bottoming out here. You can see that it actually bottomed first, then we see retail sales starting to increase. So this upward trend was being hampered by European debt crisis in 2011. As you can see here, when it peaked in 2010-2011 period, and it started to decline. This is when consumer sentiment was being dampened, and hence retail sales started to slow down. So all this comes as we zoom into the near term, where we see that during last year, end of last year, basically the fourth quarter of 2016, economy actually showed green shoots of recovery. The fourth quarter 2016 GDP growth actually recorded a very strong growth, and recently they have actually revised up GDP growth for 2016. With this, we think that it's going to further lift consumer sentiment, and we are starting to see that there's a sign of recovery for retail sales as well. In addition, we think that for the second evidence that would support a higher consumer confidence would be the wealth effect. As you mentioned just now, when we went through deleveraging, excuse me. So as we went through deleveraging, the liabilities growth actually, the assets growth actually outpaced liabilities growth. So at this point of time, a typical Singapore household would start to feel the wealth effect, and this will further spur household spending. We'll touch a bit more about wealth effect later. So let's look into why we think that Singapore GDP or Singapore economy is going to recover soon. So just a little bit backdrop on Singapore GDP component. It's being formed by services producing industries and goods producing industry, with services producing industries being the major contributor to SG GDP at 67%, and the remainder being goods producing industries. So as you can look at the orange line here, it has been hovering above 0%, and the only time that it has went into a slight contraction, it was during 2009, where we had a global financial crisis, and we see a slight contraction of negative 0.8%. Hence, we do not think that in near term, if you ever go into the contraction territory, the main reason being that, firstly, services producing industries are actually backed by resilient domestic demand. So services producing industries are made up by wholesale, retail sales sector. So we think that domestic demand will be able to provide quite a resilient growth to it. Secondly, the current situation is nowhere near the global financial crisis as global economy outlook brightens. Why do we say that? It's because that IMF is actually looking to revise the forecast for 2017 as well as 18 as the global economic growth prospect brightens. We're also being more upbeat due to the higher external demand, the rebounding global commodity prices, mainly on oil prices, and domestic reforms within the region itself. So all these would be able to lift external demand and hence lift our wholesale trade sales as well. Next, if we look into the manufacturing sector, which are actually supporting or are the major contributor of why we see there's an uplift in GDP growth in Singapore. It has been improving since early of 2016. It rebounded to about 3% year-on-year growth in 2016 versus the 3% contraction in the year before. And it has recorded a strong recovery in the fourth quarter in 2016. And if you are following the news, it is also supporting the growth for Singapore economy for the first quarter of this year as well. So with that, given the improving goods producing industries and the resilient services producing industries, this would actually indicate that there will be a pickup in economic growth in near term. So with a better or a more upbeat prospect on Singapore economy, we think that the consumer confidence for Singapore will be picking up in near term. So just a background on the Singapore Mastercard Asia Pacific consumer confidence. It's a semi-annual consumer survey, and the latest consumer survey was taken in second half of last year. This is actually at a pessimist level, but we think that this has yet to price in the second half GDP growth of Singapore, which in the fourth quarter itself recorded a strong rebound. So it has yet, so we think that it's going to, this is where it's going to bottom out, given that it hasn't taken into consideration of the recent fourth quarter and fourth quarter of 2016 as well as first quarter of 2017's rebound in Singapore economy. And as mentioned just now, the second supporting evidence or second supporting drivers that's going to lift consumer sentiment and hence spur spending is that Singaporeans are actually feeling more wealthier these days. So as you can see from this chart itself, net assets grew at a 9-year CAGR of 6.9%, and this is actually higher than the 9-year CAGR of 5.7% Singapore nominal GDP growth. Yes, there are some concerns being that household leverage has actually increased dramatically over the years ever since that Singapore has gone monetary easing following US footsteps. But if we look into the average asset to liabilities ratio, it's actually covered at 6.2 times, and these debts are actually backed by assets which are unlikely to experience a sharp decrease in their value. And these assets are basically currency and deposits, the CPF, as well as residential property. So these three forms 83% of 2016 household assets. As such, we do not think that there will be any point in near term that consumers would think would, let me backtrack. At any point of this time, we do not think that consumers would feel at risk of there's a heavier burden to service their debt, and they are unable to service their debt. So having said what are the drivers that would lift consumer sentiment, let's take a look at what are Singaporeans spending on. So this is a chart on the distribution of monthly household expenditure for a typical Singaporean household. So most of us are actually spending more on housing and housing related expenditure, food, as well as transportation. So it forms about 65% of household expenditures. So if we leave housing and housing related expenditures, and we look into the second categories, or the second categories of expenditures that we spend most on, would be F&B. There are two indicators that we would be looking at for F&B. One being the retail sales index for food and beverages. The second one will be of F&B services index. So these are products that comprises F&B. For example, instant noodles, potato chips, or rice, or a can of soda. But if you look at F&B services, it would be comprising of the meal being served in front of you in restaurants, in fast food outlets. So these meals are actually very readily prepared for you. So nonetheless, both of these indicators are actually pointing upwards, showing that Singaporeans are actually more willing to spend on F&B, which could be in terms of volume or value. As for the services index, we are also seeing upward trend for all sub-indices, and most notably, I would like to touch on restaurants, which is most sensitive to economic climate, is also gaining traction. This underscores that consumers are more optimistic on their future income. Second, we would like to touch on supermarkets. As you know, that supermarkets, as compared to mini-marts, will require more money and travel time. They offer products which are of higher price points compared to mini-marts, a wider range as well. And hence, you can see that there's a relatively inverse relationship between this orange line as compared to the light blue line. So if we see a decrease in the mini-marts, we should be seeing that there will be an uptick on supermarkets as consumers shift their preference to visit supermarkets more often. Next, if we look into cyclical goods, which we took these two indicators into consideration, we can also see that there's an uptick in both of these sub-indices, showing that there may be a rebound or a recovery in a broader cyclical expenditures. So this sums up what we are optimistic about retail sales. So we think that supermarkets are coming back. Spending on supermarkets are coming back. People are eating more often. They are spending more, and they are more willing to spend on luxury goods as well. So how is that sustainable? So hence, we take a look into the purchasing power of consumers and the cost of these products and services. For purchasing power, let's take a look at employment and wages. Yes, there are some concerns in the market that unemployment rate is actually at near-term high at 2.2%. But if you compare in the longer term, where we can see that there's a all-time high at 3.5% unemployed rate in 2009, where global financial crisis took place. So if you look at the recent 2.2% and the unemployment rate in recent years is actually quite stable and low at about 2%. So given that this tight labor market condition, it should be able to underpin wage growth in near term. As you can see that there's an upward trend for monthly average earnings. Hence, this actually supports our view on higher household spending as well. And if you look into inflation, it's quite muted in near term, and we think that even though wholesale prices are at an upward trend, just to backtrack, wholesale prices is actually factory gate price, so it's how much of retail, it indicates the raw input prices for retailers. Although that is going on an upward trend, and it might imply that we may be seeing a higher retailing prices, but as retailers pass on the cost to consumers. But we are still of the view that inflation should remain muted in near term. Why? This is because that we think that because of the intensified competition in Singapore retail landscape, it would limit the magnitude of how much retailers will be able to pass on the higher cost to consumers. And having said that, if we look into the operating expenditures, we see that there's some pressure easing off from labor costs as well as rental expenses. So this should be able to offset the higher input costs, and hence may try to sustain businesses' operating expenditure. And hence, we think that although there will be a rising factory prices, inflation should remain muted in the near term. Another factor that might dampen consumer sentiment would be the sharp interest rate hikes. So recall that our in-house view is that US Fed is behind the curve of rising interest rate, and interest rate hike is going to be steep instead of the expected gradual raise. So what does interest rate hike means to a consumer? So firstly, it will be on currency risk. Higher US interest rate could in turn weaken local currency. But we think that with Singapore Central Bank, MAS, maintaining its neutral policy stance of 0% appreciation, this should be able to contain pressure on exchange rates as well as consumer prices. So this this statement itself actually would also support our thesis of why we think that inflation should remain muted in near term. And secondly, if we look into credit implication caused by a higher interest rate, which we have mentioned just now as well, that a higher interest rate might burden consumers to service debts. And we have mentioned also just now that household leverage has actually increased in recent years, but we think that the risk should be contained by favorable economic growth as long as consumers' wage continues to grow and employ a favorable, a stable employment conditions would be able to underpin wage growth in this sense. We do not see that there will be any risk coming or credit implication arising from interest rate hike. So to sum up, we continue to think that for this year, earnings will be the main factor to drive share price. And if the economy and profits are improving as per what our thesis have stated, then it should be able to catch up with the valuation. Here we provided the 5-year historical PE chart for consumer goods index as well as consumer services index, and we have actually seen that consumer services index has been trading at above its 5-year average plus 1 standard deviation. So we are waiting for more clarity for it to catch up with this valuation. So if we look into the list of consumer sectors stocks, so we have listed the top 10 market cap, and from this top 10 market cap, we have ratings on 2 of the counters, F&N and Sheng Siong. And for small cap wise, we have a coverage on Old Chang Kee. So just to reiterate that we have an accumulate rating on Sheng Siong with a target price of $1.06 and a buy rating on Old Chang Kee with a target price of 98 cents. So why do we like these two companies? These two companies are still expanding on their store counts. They are expanding on their margins in terms of benefiting from economies of scale as well as improved operating efficiencies. So with that, I would like to sum up our thesis that retail sales is going to rebound in near term. Although there's lingering uncertainties rising from geopolitical risks, we think that green shoots of recovery in the Singapore economy is still there on the back of improving goods producing industries. We also think that these brighter prospects on Singapore economy should lift consumer sentiment, and wealth effect coming from an increasing household net worth should spur expenditure as well. We also think that with higher wages and a stable unemployment rate, consumers have higher purchasing power, and not to mention that there's a muted inflation in near term. We also noted there are few positive signals, mainly on F&B, on supermarket, as well on cyclical goods. So all this pointing to a rebound in retail sales. And hence, we have an overweight rating on Singapore consumer sector. With this, we would like to end our presentation for this week's webinar. We'll now open the floor to questions. Thank you.
Hi, morning everyone. Home here. There is a question on Fraser Center Point, since we're talking about retail today. So the question is, when will FCT's DPU start to increase after, because we all know that they are doing the AEI for North Point, and North Point is one of the biggest mall in the portfolio. So question is, when will DPU increase after the AEI activity in North Point completes this year? But for FCT, the thing with the good thing is that the okay, management has this internal target that is to aim to increase DPU every year, and they have this mechanism whereby they can choose to take the management fees either in units, that means in shares, or in cash. So in times of periods of downtime for their malls, we saw that for Causeway Point, the Causeway Point AEI, when the mall was down, so your rental income was affected. Management can actually choose to take more management fees in units rather than in cash. So when they take more in units, that actually frees up more cash for distributions. And then subsequently, when the mall gets completed for all the renovations and then your rental income starts to go up again, then you adjust back by taking more in cash. So that actually smooths out the earnings. So you can see that even when Causeway Point was doing AEI, the DPU was actually up because they actually took more in units than in cash. So I believe the same will happen this year. So such that they will try as much as possible, I believe, to minimize the volatility in the DPU. So I think that would not be a major concern for FCT, because you look at the track record they have in rejuvenating the malls, is the return on investment is actually pretty high. And I think this is a necessary step for them to renovate North Point as well, because the upcoming North Point City in 2018, they need to rejuvenate the old North Point to integrate the old one to the new one. So it is a necessary step.
Hi, since there's a general interest on Thai baht, um, so oh, sorry to this point that currently we do not have any have coverage on Thai baht, but if if you compare Thai baht with FNN, we are actually more upbeat on Thai baht, given one, their diverse range of product offerings, ranging from alcohol, which provides the higher margins, to mineral water, to non-alcoholic beverage. So secondly, we are also upbeat about its Thailand's demographic as well as geographic factors. Thirdly, we are also positive about its variable as well as a sustainable margin. And risk for Thai baht would be the higher excise tax in Thailand. There's a question on compared to Sheng Siong, wouldn't a dairy farm be more attractive since it's more diversified? In this sense, sorry that we have no coverage on dairy farm, but yes, for dairy farm is more diversified in terms of geographic region as well. And if you compare Singapore's retail landscape with Indonesia or its regional peers, including China, Hong Kong side, which dairy farm has exposure to. Our Asian peers retail landscape is actually more upbeat as compared to Singapore. So in this sense, yes, you can actually draw a conclusion that dairy farm is more attractive, being more diversified.
Hi, this is Richard. There's a question. The question is with regards to Soilbuild REIT and industrial REIT sector, are the supply of business parks really low in Singapore compared to standard warehouses? Yes, the answer is yes. If you refer to all our past industrial REIT sector report, we showed a bar chart showing the upcoming supply. And if I recall, I think from 2018 onwards, there's no planned supply for business park at the moment.
Hi guys, Tong here again. So we have a follow-up question on retail REITs. So the question is, in view of the pickup in retail spending and the optimistic bid for Jurong Point, does that imply that it's time to be more optimistic on retail REITs like FCT? So I think for retail REITs there are many angles to look at it. One way is to look at it from the consumption, demand, the retail spending point of view. So that one will actually improve the prospects for your tenants, and then will in turn improve the amount of rent that you can collect. But okay, that is on one aspect. The other aspect to look at it from is the attractiveness of of REITs as an asset class, because of our view that we think that the Fed is behind the curve in raising rates. So as interest rates go up, you're gonna see a drop in the attractiveness of REITs as an asset class. So we saw that over the last few years, REITs did well. That is and on the back of a few accommodative factors. Firstly, we have low interest rates, very accommodative monetary policies. Then secondly, we had we had subdued growth. So easy monetary policies and subdued growth. And so that actually led to a lot of funds trying to chase for yield, and that was why REITs did well. So now I think the easy monetary policies that front is already starting to reverse. Um, and then we see a lot of companies that are seeing improving growth as well. So on that front, I think there are more opportunities for funds, more companies to look at. So as a whole, I think as an asset class, REITs will not be looking as favorable as over the last few years. And I think you can already start to see that over the last few years, REITs has outperformed um, the index and then developers as well. But you look at this year to date, the REITs have actually started to underperform. And then okay, then for the okay for the bid on Jurong Point, the 3003 PSF, yeah, that is really very bullish, because that you just if you compare with the other um, capital values of other malls, other suburban malls, you see like North Point, Causeway Point, they trade about 2007, 2008 PSF. So 3003 is really very bullish. But do not forget that a lot of times all these big names, they buy all these physical properties, they actually have a very long-term view when they buy all these properties. Remember, like we touched on this before, in 2000 and I can't remember, 2007 or 8, we had this record high PSF paid for office properties at that point in time. And then thereafter, we went into the GFC, we went into contraction for many quarters until around 2001. After 2010, then we returned to the where we saw the peak price paid for the office properties at that time. So these buyers of physical properties, they actually have a very long-term view. It may not necessarily signify the bottom in prices of physical properties. So if you want to buy REITs, um, to track the physical properties transactions, to use them as a gauge to think that it's a bottom, may not be that accurate. And for retail malls, I think we are looking at like some kind of structural change as well, because do not forget the competition from e-commerce, and then you see the new Singpo Center that is coming up. The experience they're giving consumers is that they're going to integrate online and offline shopping. So so you have a situation where you can go into the shops, buy something, and then do like an online transaction inside the mall, inside the shop, and the shop can actually have it delivered to you from their warehouse. So that kind of experience improves the shopping experience for the shoppers, in that you can go around shopping after you shop. They get it sent to you, but you don't have to carry your bags around. And for the tenants, it's also good because they save on the storage space in the shops. So they can just store all their stuff at the warehouse. So this kind of structural change will just mean that retailers could just need less and less storefronts in the brick and mortar stores.
There's a question on the Alexandra Technopark. I think that's inside Fraser's Commercial Trust. We don't cover that stock. Probably best to go and check the annual report if you're a shareholder.
Hi everyone, Tehong here again. So we have another question on REITs. So given that I was not very bullish on REITs just now, we have a client asking. So if that's the case, how should we hedge if we already hold a portfolio of REITs? Okay, generally at the start of this year we were not bullish on REITs, so we were underweight the sector. And at the same time we were advocating for a switch out of REITs to developers. So I think in the next, I think from our technical analysis, in the next short term, maybe about a month or so, I think you can see some kind of weakness in the developer's share price. That is from the TA point of view. We would think that that would be a good chance to actually reduce exposure to REITs and switch out to developers instead, because we think that this year the climate is better for developers. Because like I mentioned, there are actually two opposing forces facing REITs now. There is the first one, which is the underlying fundamentals, which we say that consumer sentiment, consumption power is improving, right? So underlying performance fundamentally for REITs should improve. That is the one positive force. But the other negative force is the rising interest rates, right? When interest rates go up, your 10-year yields go up, your spread of the REITs versus the risk-free rate goes down. So your attractiveness as an asset class goes down. So these two opposing forces are actually acting on REITs. So, but why do we still think that is underweight? Because I actually think that the second factor, the increase in interest rates, the negative force will actually have a bigger impact in REITs than the improvement in the positive fundamentals. Because if you think of, let's say for example, you think of a mall. Let's say I'm a mall. I have I earn $100 in rental income every year. So every year, let's say I have $15 worth of income that is due for reversions, rental reversions, right? And because my underlying sales are better, right? So I can get rental escalations. So previously, maybe out of this $15, I can get a 5% escalation. But now because retail sales is better, I get a 7% escalation. So I get an extra 2% escalation, right? From the $15, for example. So 2% times $15 is, if you work out the impact on net DPU, right, it's actually like a double digit decimal point impact on DPU. So maybe last time if I'm yielding 6%, now I'll be yielding maybe 6.0203%. So the impact from improved rental reversions on DPU versus the negative impact from the increase in interest rates, the impact from the negative interest rates is going to be definitely higher than the positive impact from DPU growth from better rental reversions. So that's why we think that it's still a good time to switch out of reduce our exposure to REITs. Go into developers. We have other buy calls and accumulate calls that have a pretty high and decent dividend yield as well, like sets, like Chunky, and so ComfortDelGro as well. So those are decent dividend yields and still got a bit of capital upside. So these are your options that you can consider if you want to reduce your exposure to REITs, but still want something with decent like passive income from dividends. Okay, everybody, I think we are not seeing any more questions coming out, so we will call an end to this week's webinar. We hope to see you guys again next week. Thanks and see you.